Good afternoon. You're listening to Carl Potter, Principal and Managing Director at Avis & Young. Welcome to this webinar, which looks at funding of real estate in a rapidly changing world. This event follows an earlier seminar which we held at our Brindley Place offices in November 2019, and how much has changed since. I'm joined today by a panel of highly respected and senior individuals from the legal, accountancy, and property professions. And alongside our main speaker for today, Roger Clark, Managing Director and Head of Capital Markets at IPSX. Joining Roger, and in order of appearance today, I have Peter O'Brien, UK Head of Valuation at Avis & Young, Stuart Walmsley, Partner at Eversheds, and Mark Roberts, Partner at Grant Thornton. During the webinar, all other attendees will be on mute, but please do use the questions function on your screens so we can pick these up in the Q&A session to follow. So to start, Roger, can I ask you to set the scene and outline what IPSX have been achieving since launch in November, and about the launch of your wholesale market, which I know has attracted a lot of attention from real estate owners, looking at what IPS has to offer. Roger?
Carl, yes, thank you, and good afternoon, everybody. If we could move on to the next slide, I think what I'd like to just very briefly do is in order to introduce wholesale, just remind everybody what IPSX is and set out the key differences between the two markets. IPSX Prime, which would have been the subject of discussion back in November, and IPSX Wholesale, which was approved by the FCA in December of last year. So IPSX as a platform is a stock exchange which is dedicated to commercial real estate. We are a recognised investment exchange designated so by the FCA. So we're fully regulated by the FCA, just like the London Stock Exchange and any other large exchanges that people are already familiar with. And we're also a recognised stock exchange as far as HMRC are concerned. And that's important because it means that companies which list on IPSX can be REITs. IPSX is also a fully MiFID II compliant platform, which means all sorts of things in terms of European securities legislation. But of particular interest is it means that the shares listed on our exchange are eligible to be held in SIPs or ISAs. So we're a stock exchange and companies list on our exchange just like any other stock market that people are familiar with. But the big difference is, and the thing that's unique about IPSX, we're the only exchange in the world that's offering this, is that companies who own single pieces of real estate can list on our markets. And that's important because that means rather than being just another place where you can buy shares in a property company, the big vision that IPSX is here to deliver is that you can now buy shares in buildings, securitized buildings. The process is similar to any other exchange in that companies list on our market, and that means, because they're listed, that owners of those shares afterwards can buy and sell those shares at any time they want to. There are market makers who provide firm two-way prices all day long. And that's, of course, important because that means that we will never see gating, which is everyone will be aware is happening across the retail funds market at the moment. And we'll also never see illusory liquidity, which is sometimes occurs in some of the technical listings that happen on some other stock markets. As I said, anybody can hold shares on IPSX Prime. Let me just remind people the key characteristics of our IPSX Prime market. It's for all investors, including retail. So SIPs and ISAs, people can buy shares through the retail platforms. Like all regulated stock markets, there has to be at least a 25% free float. That means that the original owner of the building that they want to list on the market has to sell at least 25% of the shares. That means, of course, there's a great deal of flexibility in how much they might wish to retain. This market is designed for stabilized income producing assets, analogous to core or core plus strategies in private funds. So low risk, low leverage, LTV is limited to 40%. A prospectus has to be produced, which is pre-vetted by the UKLA. And as I mentioned, liquidity is provided by market makers. And that means, and it's a quote-driven system, by the way, just to emphasize that, which means all day long, market makers will make firm two-way prices. So you can always buy and sell shares in these buildings. So the new market, wholesale, has some important differences. The first is that it's only open to institutional investors. That is, of course, institutions, eligible counterparties, professional investors. It follows from this that some of the protections that are deemed necessary for retail investors don't need to be there. And when I say protections, of course, there's still all of the full levels of disclosure, transparency, and regulation that you'd expect. But it does mean that there is no prescribed minimum free float, and I'll come back to the relevance of that in a moment. It also means that the assets don't need to be stabilized, low risk, income producing assets. There is scope on wholesale to raise finance for development projects, for refurbishments. It's also possible for JV REITs to list on this market with extremely small free floats, as I mentioned, less than 25%. In some cases, it could be as little as a 1% free float for the very largest assets. A higher LTV is allowed. We actually have set the limit at 80% because there has to be a limit, because there has to be a rule, but in practice that means pretty much any level of commercially realistic leverage is allowed. And another really important difference is there's no prospectus required on this market, only an admission document. It doesn't need to be pre-approved by the FCA. It just needs to be submitted to us as an exchange for approval at the end of the process. And that, of course, has significant implications for time and cost, both of which are heavily reduced. So IPSX as a whole makes a key difference to the real estate sector. The key difference being that now any investor on the prime market, even the man in the street, but on both markets, investors who aren't large enough or have the sufficient expertise to buy and manage property assets themselves, it now means that the asset class is opened up to all of them. And even the largest pieces of real estate can now be owned, which are normally only owned by the very larger institutions, private equity, sovereign wealth funds. These are now available to a huge pool of new capital. Huge amounts of capital can now come into the sector, which otherwise can't at the moment. So that's just setting the scene. Can I have the next slide, please? I want to make the point here very briefly that these are companies which own these real estate assets, and they're companies which issue their shares onto our markets. So that means that there will be a board of directors, and many investors will be comforted by the fact that these directors have to be independent of the vendor. So even if the vendor retains an economic interest in the company, an independent board of directors is responsible for the strategic decision making around the asset that the company owns, for leading communication with shareholders, investor relations, disclosures necessary to observe ongoing obligations, and really importantly, monitoring any outsourced asset management. In terms of the governance of these companies, they're listed companies, so they have to follow corporate governance and they have to apply this standard commensurate with their size. There are options available to people, but these codes, when followed, means that the governance will be just like other listed companies of similar sizes. Asset management is a key part of the equity story here. Investors will absolutely want and need to know that the asset that they own is being managed properly. There's an attraction for many owners of real estate that they may actually be able to recycle capital, have liquidity events, sell assets, but still be able to be retained as the best and most appropriate expert to manage the asset. Of course, that means for certain owners and sponsors that there can be annuity income streams being created through these listings. May I have the next slide, please? This is a timetable now specific to the wholesale market. And I think the thing that one really wants to bring out here is just how fast this sales process can be. The IPF says in recent research that on average, selling a direct asset in the UK can take anything up to 180 days or more. And people might instinctively think that an IPO process is very complex and very time consuming. It's not necessarily complex and time consuming. There's a lot of disclosure that has to be got right, but a lot of due diligence is therefore included in these disclosure documents, and they can be prepared by expert advisors very quickly. From start to finish, a wholesale listing could be done as quickly as 8 weeks. And I think that's an important myth to set aside, that this process is long and unwieldy. Here, there's a lot of detail that I don't propose to go into, but at certain points in this process, there are deadlines, milestones where documents need to be filed. But again, any issue as lawyers, financial advisors will be perfectly comfortable with this process and will be able to take them through it. May I have the next slide, please? Now, I think a key part of this for owners of real estate, a key part of this concept is, as I mentioned earlier on, the fact that it will attract enormous swathes of new capital potentially into the market. I'll just give you one example there. There is an increasingly growing important part of the UK pension fund industry is the defined contribution market, which as defined benefit schemes go into runoff and will, I would say, never be created again. DC money will get more and more important. But as a rule, DC money can only invest into assets that have daily pricing and liquidity available to them. So the only way they can invest into real estate, and the only way they do invest into real estate today, is by buying shares in REITs. Now, that's fine as far as it goes. But as I mentioned earlier on, what we're about here at IPSX is providing very transparent access to securitized buildings, not large property companies, portfolios, where the underlying investor doesn't get any say in or choice as to which assets are bought. So for the owner of the assets looking to use IPSX, if they bring products to the market which is new and hitherto unavailable, that's extremely interesting to the buy side. I mentioned the transparent pricing already. Of course, that's necessary, and I've mentioned the fact that these companies will have the same levels of regulation and protection for investors that any other company like a Vodafone or an RBS that's listed on the LSE will. If you put all of this together, this is a really compelling new offering to investors, and the interest that is being communicated to us is really powerful. Now, just to close before I pause, we just want to show you here a few slides that are photographs from our website of how our trading platform will actually look for investors. And here we have this would be a sort of landing page where investors looking to buy or sell shares, or who own shares, can go onto our website and see this sort of headline information about companies which are listed. We go on to the next one. If we take Cobra Place and sort of drill down into it, then there's a homepage for the security itself, which has details. And of course, as the life of the company goes on, all regulatory filings or documents, the updated valuation, which is done every 6 months, that will all be captured here on our website. And if we go to the next page, there's then just some analytics around the actual share performance, trading volume data, etc. So it's going to make buildings look just like, as I say, buying and selling shares does in the LSE today. And this is really, really interesting for investors, and that's therefore exciting for owners. Carl, I'm going to pause there. Thank you.
Thank you very much, Roger. That's a really helpful update of your progress and a very, very interesting assessment of the speed to market which the exchange offers. I'm going to turn next to Peter O'Brien. Peter, as UK Head of Valuation at Avison Young, you must come across a wide range of ways in which both sectors and geographies are weathering the fundamental shifts we've been seeing in our economy. But who do you perceive the regional markets are faring?
Yeah, thank you, Carl, and thank you, Roger, for that overview. To do that, I think it's important that we extrapolate that out to the wider market first before we drill down into particular regions. And firstly, I'd just like to go back to around the 16th of March when the social distancing was introduced and where valuers were at that stage, because that was very close to the quarter end. And clearly, there wasn't a lot of time between the 16th of March and the end of March to have that quarterly valuation truly reflecting where the market was. So valuers at that point in time across the country were scratching around, investigating various deals, what's fallen over, what hasn't, what's been price chipped, to feed that into the valuations. Now, what actually transpired when we got past the quarter end was, if we look at the IPD index, and this is a great index because it encompasses both prime and secondary assets, the IP index only fell a capital value fall of only 2.75% across all sectors. Now, clearly, given all the noise that was happening in the market at that time between the 16th of March and the end of March, there was a great deal happening around the noise of how the market was reacting, but not a great deal in terms of deals. And 2.75% fall is very small, I'm sure you'll agree. Now, that really didn't reflect where the market truly was necessarily. One would have thought, and what transpired post that date was an awful lot more transparency around deals that had actually happened and how far the market had actually moved. So we've been tracking deals post that date and up to now, and we've tracked around 2.5–3 billion of transactions that have happened across all sectors in that 2-month period. If we look at that and compare that to 2019, when during the same 2 months there was around £8 billion worth of deals, you can see how much the market had fallen off and how much it had contracted. And why was it like that? Well, a number of reasons. No one wants to sell into an uncertain market. There was no real distress. Lenders were giving people interest rate holidays, etc. So all help was given to the property owner not to have to sell. But there were a number of positive transactions in that period with very minimal price chips, which gave us a good idea as to where the market had truly moved to. Fast forward to June. How's the market going to look in June, and what's it going to look like as the quarter date? Well, it's anyone's guess at the moment, but clearly there's a lot that has happened since March to June, and there's more happening around the support for tenants, in that landlords can't go for foreclosure, etc. So people will be all eyes on the June quarter date for rental payments. The viewpoint is we know that the rental payments in March were lower than half what they're expected to be. The viewpoint as at June, I've heard rumours that it could be around 10% of what they should be. So clearly all of that will be feeding into the valuations. And as at June, the minus 2.5% we saw in March, in fast forward to June, could be double figures. So clearly it's a very uncertain market and uncertain period we're actually going through right now. Now, if we widen that out to the regional markets and what we're seeing in the regional markets, one key sort of example of where we've gone from to is 55 Colmore Row in Birmingham. That's over £100 million deal. That was under offer pre-COVID. It's under offer a record-breaking yield, net initial yield for central Birmingham of 4.6%. I think there was only one ever deal before that of 4.6%. And the prime yield, Avison Young prime yield, was 5% for central Birmingham. So it's a record-breaking deal. That deal is on hold. Is it on hold because of COVID? Probably. Is it on hold because we work as a tenant? Probably that as well. But clearly that's something that we're all tracking and is a real bellwether as to where the market and what's happening in the market and where it's gone to. But there's still things happening in the background. There's an industrial estate that's come to market and gone under offer. It's come to market. It's only 12 million in lot size, but there's multiple offers and bids on that at 7%. It came to market at 8.5%. So clearly there's still appetite there and transactions are still happening and there's still investor appetite there. The other big deal that's happening in the market in that region would be the Next HQ office deal. That's a sale and leaseback to Next for 25 years RPI, 25-year RPI kickers, and that's under offer at 48 million and 4.5%. So there's a great deal of appetite there in the background, but it's not translating into a large number of deals which we normally see in a normalized market. Now, when will that begin to unleash and actually begin to normalize? Well, going into all of this, there was a great deal, a wall of equity, some might say, of waiting in the wings to enter the UK market. And that's because we kind of, I say, in inverted commas, had Brexit sorted. So the UK market was a great destination to put your money. Now, COVID blew up and that kind of stemmed that flow, but that wall of equity is still very much there for the right deals. And as long as the market is repricing correctly and the lenders, the key point is the lenders come back to the market in a big way to help with the recovery, things will become normalized, we're expecting, in quite a quick way. And the regions specifically will be a key part of that. There is still a great focus on the regions, both Manchester and Birmingham sucking up that investment. And there's still good occupational demand in the regions. Clearly, occupational demand is changing rapidly and has changed over the last few weeks. But we're tracking that, and there still is appetite there for people who are moving from one building to another, where people have actually already given notice on their leases, they are still minded to go ahead with occupying new space. So the occupational demand is still going to be relatively good. It's going to be good in a different way, as we know. And so occupational demand is still going to be there and investment demand will still be there. So we think the regions will perform quite well coming out of this. And that's, like I said, providing that the loan security market, the banks come back in the same way, albeit with repriced levels, but whether they come back in the same way is a big question. But we're still very positive coming out of this, and we do think the recovery will start between now and year end. It's just how far in the year we have to wait for that, and how long and how well social distancing goes, as we all see that every day as we go about our lives. So thank you very much, Carl. I'll like to take questions at the end.
Thank you, Pete. That's really interesting. A lot of positivity there, and some good talk about the level of equity that's in the market. But Stuart, we've heard a lot of recent analysis on how the landlord and investor side of the market are faring, but I'd suggest that actually it's quite a good time for corporates to be revisiting their assets and how they see the world. How do you view that market at the moment?
Yeah, I mean, obviously, thanks, Carl. It is an interesting market. I think any office owner or any landlord or property owner is going to be looking at their assets at the moment. They're going to be looking at their businesses, seeing where there are opportunities to free up equity, have cash to maybe siphon to other parts of their business. But it's a big chunk of their balance sheet, and if they have the opportunity to do something with it to try and free up some of that cash, then I can't imagine they're not doing that currently. I mean, there won't be any business in the UK that isn't having some impact from the whole COVID fiasco. So, as lawyers, we are certainly working with a number of corporate, owner occupiers, looking at what options are to them, and really, we've mentioned on this call already a number of those options, whether it's a sale and leaseback or IPSX as a possibility, or anything that involves bringing in some kind of investor to try and free up some of that cash for their balance sheet.
Thanks, Stuart. Mark, just picking up from those things, what's your perspective, particularly with the Birmingham focus and the strength of the city as a location for corporates?
I think it's getting stronger and stronger. I mean, obviously, the HS2 discussions, I think we see it as an extension of London, don't we? I think when you look at the accounting functions, and back office functions for large corporates in London based in Birmingham, I think it's helped cement the position. Of course, HSBC taking significant long-term view, retained long-term view in Birmingham has only helped. So I think, as we progress through costs of property in London and availability of property in London, I think we'll see a much stronger relationship between Birmingham and London in the way that they reconfigure their footprint as we come out of COVID.
Thanks, Mark. I think before we turn to questions raised by our attendees, and those are starting to come through now on the Q&A, please do remember that questions can be raised by using the live Zoom functions. There's a small number of questions I'd like to put to our panel in response to what they've just outlined. And the first of those, Stuart, rent collections under pressure and the June quarter days looming. So what changes do you envisage might be needed to the way the market has traditionally worked?
Yeah, rent collections definitely are under pressure, and I think unless you're sitting on a portfolio of supermarkets, there isn't a landlord that's not going to be suffering some kind of consequences as a result of COVID. So the government has done a lot to help tenants, maybe not so much on the landlord side, and everybody loves to hate the person collecting the money, but we're doing a lot of work with tenants and landlords. Ultimately, to get through this, there's going to have to be a lot of collaboration. There's going to be much more of landlords working with tenants to look at different rent structures, whether it's some form of profit sharing from the businesses, but working collaboratively to try and find a way that works for both, really. And I think as a landlord, maybe looking at your assets and seeing whether there are ways of restructuring them to try and provide different sources of revenue. I think it's probably something that was happening in the market anyway, and all that COVID has done is really supercharged that process. So it's an interesting time, and a lot of people spending a lot of time frantically running around trying to work out the best way of going forward. And I think, as Peter said, nobody really quite knows what the full impact this is going to be, but it's something that's going to pan out in the next weeks and months, and it's really just a question of everybody putting together as landlord and tenant to find a structure that works.
Thanks, Stuart. Any of our other panelists got a view on that?
Yeah, I mean, personally, I think the rent collection point is very much like you said. It's about collaboration, and it's about relationships with your tenants and having those open conversations. There's some very, very open and public conversations being had between Travelodge and their landlords at the moment, and we've been watching that with interest. And I think it's having that, and I think it's going to come down to compromise at the end of the day. Yes, they owe X amount of money, but these are unprecedented times. And I think landlords are going to have to give a little as well. And it's more advisable to do that. Either give a little or don't get anything, I think, is going to be the circumstance. Each situation is going to be different, but I think that is what landlords are facing right now, given the amount of help that's been given to tenants by the government.
Thanks very much for that, Peter. Roger, just turning to you now, can we talk a little bit more about the liquidity needs of markets? How is liquidity in the market working at the moment, and particularly in the context of the current crisis?
Well, I think it's very interesting what we're seeing at the moment in terms of investor behaviour. Let's start with the traditional institutional investors in equity markets. They are currently today carrying allocations of cash within their portfolios that have never been seen before. I think there are I don't have the answer to why that is. There are possible answers. It could be that they are envisioning that there will be cash calls coming from their portfolio companies, and that they're just getting ready for that. One hears anecdotally that when markets went into a tailspin back in March, people just sold whatever they could because they couldn't sell the things that they really wanted to sell. I mean, perversely, as an aside, we saw at a time when you'd expect the gold price to rally strongly, gold and gold mining companies sold off quite a lot because that was the one thing you could sell. So institutions seem to have effectively withdrawn a bit of liquidity from the market. But at exactly the same time that's been happening, we obviously in real estate, we all focus on the fact that lockdown coincided with a quarter day. It also preceded the end of the tax year, which is traditionally quite a telling time for ISA investment by retail investors. And when you speak to the larger platforms, whether it's AJ Bell or Liquidity or Interactive Investor, they tell me variously that they've had between 3 and 5 times as much volume going through their ISA subscriptions as they've ever had before. We've seen, we all know, I think those of us that follow these markets all know that there's well over £1 trillion worth of cash or cash equivalent, very liquid securities sitting within that retail investor market. And they have piled back in to the market since the lows in March. London volumes, stock market volumes, are normally around 5% driven by retail investors. In the last 6 weeks, that's been touching closer to 25%. And we've also seen, excuse me, that most of those platforms, they are, for every, excuse me, for every 1 sell order they're getting from their retail clients, they're getting 4 buy orders. So effectively, this stock market rally we've seen, and let's not forget, the stock market is up more than 20% since the lows in March. So we are technically, whatever it might feel like in the real world, we are technically in a bull market right now. And that has been driven primarily by retail investors investing for the long term. This is really good for what we've been talking about today, because retail investors tend to predominantly, without wanting to sound ageist, be older. And they tend to predominantly be investing their own portfolios to provide income in their retirement. And let's not forget that the biggest dividend payer in the UK used to be Shell, and it's not now. Bonds don't yield very much at all. And so you would expect this pool of capital to instinctively be drawn to real estate if it can find ways of buying into real estate, because notwithstanding all of the problems that Peter and Stuart have just been mentioning about around rent collection, asset-backed income streams are very attractive. So liquidity is there, and there is continuing interest for real estate there in the stock markets.
Okay, thanks very much for that, Roger. Roger, before you leave, one of the questions that's come up from one of the attendees, the question here is, why wouldn't I use the LSE rather than IPSX?
So the main reason for that, I would say, I get asked this a lot, and the main reason for that is that real estate on the LSE is less than 2% of the whole market, and it therefore tends to be verging on being irrelevant. It tends to not have many analysts, and certainly buy-side analysts, following it. Putting it at its most extreme, Unilever's market cap is twice as much as the whole of the real estate sector. So for an investment manager like a BlackRock or a Schroders, getting it right on Unilever is a lot more important than paying any attention to real estate at all. And the danger is, because everybody just wants to buy big liquid companies, that the only decision anyone takes is whether to be in SEGRO, British Land or Land Securities. And everything else runs the risk of being ignored. And in addition to that, it just gets pulled around by the wider market. British Land and Land Securities both traded completely in line with the FTSE 100 throughout February and March. They went down 30%. Now, sadly, they haven't come back up 20%. But so the danger is you get caught up in the wider equity market noise, or beta, as it's known. Meanwhile, move away from that, move away from the wider market and get listed on a dedicated property stock exchange. And you step away from all of that noise, and people are coming to a property stock exchange because they want to buy property. They're going to focus on it. They're paying attention. They like the transparency of the single asset in a corporate wrapper. And I think we're going to attract dedicated capital that wants to invest in property, rather than directional macro-driven capital that doesn't really care whether it's property or not.
Thanks, Roger. That's quite an interesting position. And you did start to talk then about British land and land securities, and we have a question here for Peter about land securities, which goes along the lines of, with the land securities retail falling 20% plus, are you suggesting, Peter, that values will be that robust when you're adjusting the June valuation figures?
Good question. Yes, fundamentally, I do. We, as a group of valuation community, in these unprecedented times, and never seen before actually during a crisis, we are getting together to discuss evidence of transactions that we've seen in the market that some other houses might not be privy to. And these meetings are chaired by the RICS, so we're not colluding. And during those meetings, we do discuss various sectors and regions and geographies, etc., and how far we think the market may have moved, and the ins and outs and the details behind those few transactions that have happened. So now more than ever, do we have a dialogue going about how the market has moved, and there's no denying that in the retail space that it's moved significantly. So yeah, I am suggesting that in all likelihood the market will fall further in June, and it's just the very nature of the beast that we're looking at right now. Yes, there's more transparency around what has happened since March, and that will just be fed into the June valuations in a normal way, but I am suggesting that, yeah.
Okay.
Unfortunately.
Thank you very much, Pete. That's a really open and honest answer, really helpful, I think, to whoever asked that. I'm going to go back to a question which I'm going to probably put towards just the panel and see who's best to answer this. But alongside liquidity needs, I think what we're experiencing is an ever greater need to have a clear understanding and a compelling understanding of trading data. And Peter, you looked earlier about the lack of comparables at the moment. We're down to something like 2.5 billion compared to 8 billion of transactions presently. Looking at both the performance of companies and assets, these need to be presented in a very transparent way to satisfy today's market. So I think, Roger, probably you're best to answer this. Are we now seeing the right options becoming available to allow this transparency?
Well, I hope so, because I hope that we're going to be a very large part of the answer for that. You know, at IPSX, companies that list on our market will have to produce Red Book compliant valuations on a 6-monthly basis, and we are because we're a dedicated property exchange. We've given a lot of thought to what we would require in terms of disclosure, rather than just saying just comply with the Red Book. So we're working closely with the valuers who are members of our exchange to generate a template of disclosure. And what this will do is it will allow investors and potential investors to see at the asset level a granularity of information, much of which will be forward-looking, which is just not possible to get when you look at the annual report of a large listed REIT today. And that transparency is important, Carl, because it's the transparency of being able to look forward and form a view as to how an asset will perform, rather than just being told how it has performed in the past, that will allow investors, on the basis of that data and the ability there on the back of that data to forecast performance, it will allow them to start to value a business and value a share on its prospective value. And let's not forget, that's what every other sector of the listed stock markets does. Every other sector, companies tell you what their earnings next year are going to be, and then leave the market to decide what multiple of those earnings they should pay. We have this slight anomaly where we say what something is worth and then invite people to either pay more or less for it than it's worth. So I think transparency is the key, and we see this when we look at the listed space today, the REITs that exist today. A lot of them do actually trade at a premium to NAV. It's again another myth that we spend a lot of our time dispelling that listed real estate always trades at a discount to NAV. Not true. A lot of it trades at a premium. All of the ones that the companies that trade at a premium are the ones where it's possible to forecast cash flows, and NAV becomes a lot less relevant. So yeah, trading data, the ability to make informed, forward-looking decisions is what every investor in every market is crying out for.
Thanks very much, Roger. We're going to change tack a little bit with the next question, and it's going to come towards you, Mark. But this is something that I think a lot of us have seen a long time coming. And the question is, what's your view about the dynamics in the local authority property sector and any impact of the Select Committee inquiry?
Yeah, a hot topic, and I suppose they must be thankful there's other things in the newspaper to take up the front page. We're actively involved with a number of councils at the present moment. They're in a push and a pull situation. They're being under pressure to bring forward developments to create jobs and bring forward land to build housing. And they're being criticised heavily for not doing it quick enough. But in the last 7 or 8 weeks, we've seen 2 or 3 projects being brought forward and the process being streamlined to make sure it's starting on site this year rather than the end of next year. I think there is a lot of criticism around investing outside of their immediate jurisdiction, and of course the type of investments they invested in. And I think we're seeing some potential risk of defaulting hypothetically on their own PWLB payments back to Treasury for those investments. I think that the good thing is the councils employ some very bright people from different industries, and they're more than capable to steer themselves through this difficult chapter. But I think primarily at the present second, they're very much focused on bringing forward major redevelopment opportunities that create jobs and then create housing. So yeah, a tricky time, and I think there's some difficult questions still to be answered.
Thanks very much for that, Mark. That's really helpful. Peter, let's turn to you. And we're hearing a lot in the market, and you mentioned earlier about the next sale and leaseback. I think there's quite a few companies rumoured to be looking at and seeing the advantages that sale and leasebacks might take in the present climate. It's not always the case that these are good things to do, but how are occupiers looking at the performance of their assets at the moment?
Yeah, it's significant at the moment. Clearly, occupiers are looking at their entire occupational real estate, and where they've got underperforming assets, they're looking to exit those underperforming assets. Clearly, if you're an occupier, an owner-occupier of a piece of real estate, IPSX is a route for you to release equity from that, and that's a reason why I mentioned the mail. I mentioned the next HQ, because it would be an ideal situation for that to go into IPSX. So I think all occupiers of real estate are just looking at ways to release equity and to push that back into their business to enable them to be a bit more liquid about the way they go about the business.
Thanks very much, Peter. And liquidity, as we all know, is really centred around the availability of debt. We've got a question here from Ed Fleischman asking, everything is predicated upon availability of debt. Are lenders showing any signs of re-entering the market? And that's to any of our panelists who feel brave enough to answer it.
Can I take that first? Thank you, Ed. Yeah, so we are in contact with multiple banks all of the time, and at the moment they've got very difficult situations internally in terms of trying to ensure that they are looking after their borrowers in the right way, giving them interest rates, holidays, etc., and dealing with all other kind of government-backed loans that are giving over and above the money they've lent on the real estate assets. Now, having conversations around when are they going to enter the market, it's very difficult. All of them have a different answer to that. Yes, they say they're still in the market. Are they truly in the market, available, to lend money and provide new debt to new borrowers? Probably not. But the general view is the high street banks will be there going forwards, and they are waiting to re-enter the market. Some of the other sort of international banks are kind of sitting on the sidelines a bit more, but certainly the high street banks, the feeling is from them that they are waiting in the wings, looking to when to re-enter the market, but it will be much later in the year when things stabilise.
And Carl, just to add, I think that's I agree with what Peter just said there. I think there's also a big opportunity for alternative lenders. You know, we're talking to a number of funds and others that are looking at the alternative lender markets in terms of the products they can offer as opportunities going forwards to help those which may be in a distressed situation where they can't, you know, there isn't readily available debt from the high street banks. So it's a very interesting market at the moment.
Okay, thanks very much for that, Stuart. There's a question here, Stuart, whilst you're in the chair, just one really firmly coming your way. The law firms have been big occupiers of space. Will the new working from home environment reduce the future demand for offices?
Very good question. I mean, look, who knows? Everybody will be watching the press about, you know, what law firms are doing. In fact, we've made an announcement this morning in terms of our task force being established to look at the use of office space going forwards. There is no suggestion that we won't maintain anything other than sort of our key offices within the right cities. You know, fundamentally, we still see a need and a requirement for office space and, you know, working in teams and training requirements for staff and associates that come through. But fundamentally, I think we've learned a big lesson from COVID, and IT platforms have held up to the needs and the demands from working from home. And I think there will be a cultural shift towards more people working either from home or from, you know, regional setups. But there will still be law firms that are occupiers within London, Manchester, Leeds, whichever city it might be.
Thanks very much for that, Stuart. Another question here, again, back to Ed Fleischman. Does the panel see public to private takeovers happening now, given that there are huge discounts to NAV?
I'll have a quick stab at that, but I think in terms of complete public to private, I'm not so sure. I think what you will see is a lot more investors, whether that's UK or overseas money, looking at public vehicles. I know that, you know, there are funds and investors circling around some of the REITs and looking at opportunities and values where they can get it, but I'm not sure that, you know, given the regulatory requirements around, you know, making offers and that sort of thing, I think we're some way off seeing that, but I do think we'll see more investment into the listed vehicles from overseas capital in particular, where they haven't traditionally done so.
Thanks very much, Stuart. So, Roger, can we turn back to you and IPSX? There's a series of questions here that really have got your name printed against them. But the first of those relates to the minimum asset or lot size for properties traded on IPSX. And the question is that when you last presented to the Midlands in November, there was suggestion of a minimum lot size. And we can't remember from the question whether it's 50 million or 100 million. And there's a suggestion that actually precluded large chunks of assets in regional cities from being traded. Have you had any further consideration to reducing that minimum lot size or having city-specific regulations?
Well, I'm very glad that that's been asked. So everything I've talked about so far in the context of IPSX, I've always talked about a single asset. And it's very opportune at this point to remind people that there can also be multiple asset issues on our exchanges, on our markets, as long as those assets have what we call a sufficient degree of commonality. And that could be that they're very homogeneous assets. It could be that it's the same credit covenant behind them. So for example, and these are genuinely just examples, we might say that a portfolio of Tesco Metros could be put together and the reason being because we think the investor if they can understand one, they can understand them all. We might think it was less acceptable to put together a portfolio of Tesco Metros and Tesco Extras, because then you're talking about very different sorts of assets. So it's definitely possible to aggregate a number of smaller assets. The actual point of the question about the size, I mean, we do give guidance that the minimum asset size should probably normally be 50 million. Partly that we give that guidance because an illisted environment to be much smaller than that means it starts to become really quite challenging to attract investor interest. And secondly, to be much smaller than that means that some of the costs of being listed, which are inevitably fixed, start to actually be quite a large proportion of the asset value. But we're definitely open to having conversations with people who, for whatever reason, would like to proceed with a smaller asset. So it's only guidance. And you know, if anybody wanted to talk to us about listing something smaller than 50 million, please do come and have a chat with me.
Thank you, Roger. Next question, again about IPSX. Before COVID, there was an increased appetite and interest from overseas buyers buying into the regions. Could IPSX be a good gateway for first-time overseas buyers to explore the various markets?
Yeah, we definitely think so. Not least because, and we certainly do. I spend a lot of time talking to overseas investors, and for a whole host of reasons, the UK is really, really, really high on people's lists still. I mean, we got pretty caught up in our own Brexit drama last year, and as I think Peter mentioned earlier on, there came a point when we thought we were through it. But I tell you, if you talk to people who sit in Hong Kong or Dubai or California, they don't think Brexit's quite as important as we do in terms of how attractive it makes the UK to invest in. And if anything, they regard Brexit as having been resolved, whereas the Eurozone maybe has similar existential issues still to come. So the UK is attractive still to overseas investors. And then it rather begs the interesting question about whether, you know, can we persuade overseas investors that the UK is more than just London? I think in terms of investment volumes and in terms of investment values, in any given year, on average, the rest of the UK is about equal to London. So look, London is big and dominant and important and attention grabbing. But I think it's true to say that a lot of overseas investors are getting their heads around moving outside London, and they're definitely beginning to see the relative valuation attractions of moving outside London. And if IPSX can help people, as it were, dip their toe in the water by buying a share of an asset rather than having to buy an asset in a region that they don't know, then hopefully that can help encourage people to look beyond London.
Super. Thanks very much, Roger. We have one final question from the audience, and I'm not sure you're going to be able to answer it, but I'm going to ask it anyway. And the question is, when will the Mailbox shares be available for investors to buy?
Yes, so the Mailbox, well, it has been rumoured in the press that the Mailbox is going to IPO on IPSX. And I can certainly say that our first transaction, which not wanting to confirm anything, may well have been a regional multi-let asset. It is near to completing its process of approval with the FCA. I mentioned earlier on about how a prospectus needs to be pre-vetted. So, you know what, that is very close. And I think, were we not in lockdown, that process would probably be alive and what we call road showing the asset now. So I think it rather depends on how soon we come out of lockdown and how soon, you know, new propositions can be put in front of people. I think the slight challenge for the Mailbox is that as we're doing right now, you can communicate with a lot of people through Zoom. But I think when you're actually trying to meet someone for the first time and to talk about a new proposition over Zoom, that might be a little bit more challenging. So I guess that's a long way of saying as soon as lockdown finishes.
Super. Thank you very much for that, Roger. I'm going to finish with a question to all of the panel, just a very short one-line answer if you can to this question. What do you see as the biggest challenge to the UK property market over the next 3 months? And I'm going to start with Mark, if I may, from Grant Thornton.
I think it's confidence. I think it's a matter of the government having a clear roadmap and people having confidence to to step out of the front doors, because that is a domino effect for retail, for restaurants, and people's general well-being. If that happens, investor confidence will follow. And I think also to expedite some of the planning around some of these major redevelopments we're looking at.
Thank you. Peter?
It's very similar to that. It's the social distancing. We see the social distancing issue right now is the biggest issue for everybody. And, you know, we can't go and see buildings to look around them to do valuations necessarily, although that's being looked at right now and we're beginning to go and look at some. And people can't go and see buildings to do deals and do due diligence. Equally, if all the due diligence is already done, to try and do searches at the local authority, that's impossible as well. So all of the social distancing aspect is locked the whole market up, the real estate market, as well as other markets. And it's as soon as social distancing becomes a bit more unlocked, if I may, then I think that is the biggest issue between now and June, and in that June being the stabilised period that we actually hopefully see and things becoming more normalised.
Thanks very much, Peter. Stuart?
Yeah, I mean, Peter and Mark have summed it up. I think, you know, unlocking of borders will also help matters in terms of people being able to travel and you know, site visits, but to some extent that can be overcome. But fundamentally, it's about getting people moving, social distancing, and really valuations. People having confidence in valuations.
Okay, and last to go, Roger.
Yeah, and just following on from what Stuart says about valuations, that for me is the key thing. So I think people have got to start paying rent. Rent isn't a voluntary payment, and I think being able to, for landlords being able to exert their rights and get rent paid is critical.
Thank you very much, Roger. That brings us to an end for today's seminar. Just to sum up some of the key points that we've been making today. High street banks are waiting in the wings to re-enter once matters have stabilised. That should be towards the end of the year. In the meantime, alternative lenders are also seeing the advantage of being active now. Brexit is just a blip. The UK is more than just London. And to get back to where we do need that stabilisation of valuations, a real understanding that, as Roger says, rent is not an option. It's something that you've signed in a contract, and therefore there needs to be a negotiation if that's going to change. But more than anything, as ever, we need confidence back into the market, both from investors and from consumers. On that note, can I thank everybody for attending and listening today? Thank you to Roger, Stuart, Peter and Mark. I think we've just about wrapped up in time, so thank you and good night.
Thank you.
Thank you. Thanks everyone. Bye-bye.